Hi, it's Aaron Merriman with LMDG. Today we're going to talk about investing in a real estate syndication versus investing in a real estate fund. Let's jump into it. Thank you for joining me today. For those of you that are new, LMDG is based here in Southern California, and we're focused on investing in multifamily apartment buildings in great coastal locations throughout Southern California. Today I wanted to touch on two different topics, and it's really a question that I get asked a lot, and that is, why do we operate as a fund structure? What is a fund? What is the difference between a fund and a syndication? And so I wanted to spend a little time today jumping into those two things and talking about them. A real estate syndication is basically a group of people getting together to invest into one specific property typically, okay? It's a simple procedure and it does have its advantages, especially when you're investing in a very, very large asset, 20, 30, 40, 50 million dollars, or something that's smaller and it's just a few friends or people that really know each other. And then a fund. So a fund is something where you're actually investing in a limited partnership, and then that partnership will go and do investments, and it will go buy properties, invest and do all the same things you would do as a syndication. But as an investor, you're getting diversification because you participate in everything that the fund does. Your money isn't tied to just one specific property. Now here at LMDG, we do operate under a fund structure. And there's a few reasons that we do that. It's something that we looked at very, very hard before we decided to go that route. And there's a number of reasons why. And the first and one of the most important is just the efficiency of it. So when you think about a syndication, it by itself is its own entity. Each property is its own business. It has its own LLC typically. It has its own batch of investors, its own bank account, its own books, everything that's required to start a business goes into doing a single property syndication. Now with a fund, you're getting efficiencies because our funds have each specific fund has three entities and that's it. You have the limited partnership entity, and this entity is what receives investor capital and then also pays out profits, returns, those kinds of things. There's an LLC that is the general partnership entity, and that's how we as the general partner get paid. And then lastly, you have the holdings entity, and this is also an LLC. It's in practice handling 95% of the transactions because it's on title for the property, and so it receives rent from tenants. It handles all the renovations and maintenance and all the trades and those guys that get paid. That all goes through this holding entity. Now, as the general partner and who's responsible for managing the fund, we're tracking everything at the property level. So from an accounting standpoint, we know all the same things at the property level that you would in a syndication, but it's much, much more streamlined and it's really efficient. And so it's cost effective, and that ultimately leads to lower administrative costs and better return for the investor. So that's one of the primary reasons that we operate as a fund versus a syndication. The other is just how we operate in practice with deal flow and buying buildings. We're buying buildings that are typically 2.5 to 7 million. And in that market, the good deals go quickly. Most of our transactions are off market. And so we're dealing with people, whether it's a broker, an attorney, an escrow company, you name it. People that are gonna tell us about deals that are not hitting the market. They're not on the MLS, not on CoStar, LoopNet, all those things. When those deals come to us, we need to be able to maneuver very, very quickly. And if we were doing a syndication, we could not do that. We would have to call a bunch of investors, make sure that we could close on time, things that would ultimately slow down our ability to actually buy property, and we would lose a lot of deals. And the downside to that is ultimately we would hurt business relationships that we've built, that we've spent years and years building, because we do what we say we're going to do. If we say we're going to buy a building, we buy it. And that's a big deal when you're talking about off-market transactions. Those are the two big reasons as to why we operate as a fund versus a syndication. Now, the other thing to keep in mind, no two funds are the same. And syndication deals can be structured differently as well. So it is important, regardless of the type of investment structure that you're participating in, that you really do your homework and you do your due diligence and understand exactly what the sponsor is going to be doing, how they want to invest, what their strategy is, and do you believe in that strategy, and do you believe in the sponsor ultimately, and that they're going to do what they say they're going to do. Now, funds sometimes get a bad rap because it's harder with some funds to get visibility into exactly how they're going to invest, where are they going to invest, and ultimately you just don't quite know what's going on. We operate differently. We're very, very hyper-focused geographically, so that's a very easy thing to explain. We also are very focused on what we're willing to invest in, and we, by definition, cannot go outside of that with our fund structure. So, if you look at our track record, the things that we've done historically in Fund 2 and Fund 3, what have you, it's very, very easy to see a trend. And so as long as you're comfortable with that trend, then what we do makes sense. The other thing when you're looking at funds is just understanding what is the fee structure, because a lot of times that is something that people get caught up on with funds as well. And there are funds that can have higher fees if they're charging an asset management fee. So they're basically charging a fee based on how much capital has been raised by the fund. If they're investing in other funds, you might have potentially other opportunities for layered in fees. So those are all things that you really want to look into. For us, again, we do operate differently. We also are just very focused on being aligned with our investors and the fees that we charge and the fund structure. So, for us, we do not charge an asset management fee. But again, super important, understand what the sponsor is investing in, what their investment strategy is, and then dig into the structure. A lot of times people kind of get those things reversed, and in the end, it doesn't matter what the structure is if you're not investing in something that has a sound track record and it's something that you believe in. So I hope that helps everybody out. Thank you again. If you're new to the channel and you haven't subscribed, please subscribe and comment. If you have any questions for me or anything about this video or some other topic, please comment as well. We're happy to answer and speak to anybody. Thank you very much.